Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by BetaShares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, BetaShares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with BetaShares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast.
Hi, my name is Hugh Lamb. I'm an investment strategist at BetaShares, and today I'll walk you through ATEC. ATEC is the BetaShares ASX Technology ETF. It provides exposure to 40 high-quality technology companies on the ASX exchange. And today I'm going to walk you through some of the key features of this fund. So this fund provides exposure, as I said, the fastest growing companies on the ASX. It tracks an index. That index is, the S&P ASX All Technology Index. So it will follow rules that the index does follow. So it will rebalance every quarter. It will pay out distributions annually, and it will also follow single stock caps of around 10%. Now, some of the key holdings within this ETF are companies that you may have heard of. Think of things like Xero, Pro Medicus, and NextDC. If I just walk you through some of the examples of these companies. So Xero provides accounting software, and right now they've been utilizing AI within their business models to help small and medium enterprises to predict and forecast their cash flows. Pro Medicus is a medical imaging software company. They've got a great piece of product that allows radiologists to stream images, and they can help diagnose different sort of images remotely. And then finally, there's NextDC within ATEC as well. NextDC has been a great company. It's an Australian data center company. So what they do essentially is they build out data centers and they'll lease out that capacity to businesses that might want to build different AI models. So we know that the demand for AI has been extremely strong, and NextDC has been benefiting quite well. So you've got exposure to those companies. So what else would you look for in something like ATF and other ETFs in general? Fees is a big thing. So if we just scroll down towards the middle of this page, you can see the key facts section here. On the second line, you'll see that the management fee and costs are 0.48%. Now, this is a amount that is charged on your investment every year. So for example, if you had $50,000 invested in ATEC, this 0.48% would mean that you pay about $240 in fees every year. So that's just to get a sense of what you're paying in terms of management fees and costs for ATEC. You can see on the right-hand side here that the net assets, or how big the ETF is, it's over $326 million. So again, it is a very attractive fund. It has grown a lot in scale. And it's because, again, it provides this pure play exposure to a dynamic part of the Australian market. Now, when we think about why you might consider ATEC within a broader portfolio, well, when we think about the technology and sector in Australia, it accounts for about 3% only of the ASX 200. So when you think about adding a sector that's underrepresented, but is growing materially faster due to the adoption of AI, we can really blend our portfolio to something that can generate higher and higher returns. And you can potentially reduce some of your exposures to other sectors that are dominating the market, such as the financials and materials sector. So we know that the growth in technology is quite strong, and that the multiples as measured by things like the price to earnings ratio might seem elevated for something like technology. However, it's important to understand and account for the growth that these companies can generate in terms of their earnings. When we adjust that growth for the PE or the price that you're paying, then that is, almost justified. So if we can account for that level of growth, then, considering an allocation to something like ATEC might make sense from a broader portfolio perspective. So you can use ATEC instead of buying individual shares. As we know, finding the best and emerging companies out there can be quite difficult. You do need to put in a lot of work in order to identify those opportunities. And even if you're picking a single stock, you are subjecting yourself into what we call idiosyncratic risk, or the risk that a single stock might not perform as well as you expected. So by investing in something like ATEC, we can diversify that risk away. So again, just to recap, ATEC is our BetaShares technology ETF, provides you exposure to 40 of the highest quality, fastest growing technologies companies on the ASX. It is charging a management fee of 0.48%, and it is available on a platform like BetaShares Direct or other brokerage platforms as well. So that's a quick recap of ATEC.
Thanks for watching this video on the RAS Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.